Hi, I'm Frank Fantozzi, President and Founder of Return on Life Wealth Partners, and welcome to Frank Wealth Insights. Today we're talking about some new key year-end tax planning strategies, practical steps to review as the year comes to the end. I'm joined by Nick Mazzone, CPA and a longtime friend. Welcome, Nick.
Thank you. Nice to be here.
Yeah, that's great. So for the audience, Nick and I met about 30 years ago, and we're not dating ourselves, but we met volunteering for the Cleveland Plain Dealer. They had one of these tax phone-a-thons, and I'm excited to hear your insights on what individuals and small business owners should be considering before year end. Before we get started, a quick reminder. This podcast is for general, informational, and educational purposes only, and does not provide specific financial, legal, or tax advice. Please always consult with your own qualified professionals before making any financial decisions. So we're going to get started here. 2025 is a high leverage planning year for a number of reasons. The One Big Beautiful Act, OBBB, was signed on July 4th, 2025 with adjustments not only to current provisions, but some new provisions. Several provisions apply retroactively to January 1st, 2025, and some changes run through 2028 and 2029, and they expire if they're not expended or made permanent. Others are not permanent, and states may not conform immediately, so federal and state returns can very much diverge from each other. So Nick, we're going to start diving in, and why don't we kind of start with some of the basics, because I know there's a lot of material. So for everyone listening, we have our little cheat sheets here because there's just a lot of new provisions and numbers and things like that. And as new as it is, I don't think we all have it all memorized at this point. But why don't we start with some of the basics, like the standard deduction and the state and local tax deduction, which has been, real prominent, pain for many people because a lot of it was really reduced in the last Tax Act.
Okay. First of all, thanks for having me here, Frank. The One Big Beautiful Tax Bill, when it was enacted back in July of this year, changed the standard deductions, increased them. For married filing joint returns, the deduction is now $31,500, which is up a couple of $1,000s from the prior year. For single individuals and married filing separately, the amount is $15,750. And if you're filing head of household, it kind of splits the difference at $23,625. There's a new addition for seniors this year. While they will normally get the regular $2,000 increase in their standard deduction because they're over 65, there is a new provision. We're going to talk about this in a little bit.
Yeah.
It was sold as the Social Security Reduction Act for taxable Social Security, but really what it is, it's a $6,000 deduction given to seniors, and it's available through 2028. There's another new provision, as you mentioned. It's the state and local tax cap up until 2025. If you itemized your deductions, you were entitled to take no more than a $10,000 deduction. And as you pointed out, it hurts a lot of taxpayers who have high real estate taxes, high state and local taxes. They were limited to that $10,000 limitation. Under the new law, that $10,000 now jumps to $40,000 on a joint return or a single return. Married filing separately, you get half of it, you get $20,000. There are some phase-out rules. As your income goes above a certain level, that $40,000 will drop considerably, but it can never go below the $10,000 where we started.
Yeah, no, and I think that was an important change because I think the federal government, when the last tax bill came out, especially the East and West Coast people, where the property values are a lot higher and the property taxes are higher, were very upset that they were really limited. But I think what you're going to see, though, I think as we go through some of the changes, I think a lot of people felt that the Big Beautiful Bill was really a benefit to people that were extremely wealthy. And I think what you're going to find is this is really targeted to upper middle class and down, where people are still going to benefit. They might have some phase outs, but based on the income limits, like on the SALT deduction, once you make over, I believe, $600,000, you're completely phased out. So for the ultra rich, they're still going to have the limitations. I think the key thing to keep in mind is with a lot of these phase outs, and they're different for a lot of the new deductions and all that, is that they're going to be phase out limitations, but for many people, they're going to be able to benefit from it. So I think that's a good directional path for the government. So the next area, we're going to talk about some 4 new deductions created by the big beautiful bill that are going to run from 2025 to 2028. So these are not permanent. So at the end of 2028, if the government doesn't do anything, they're going to expire. So they would either need to extend it again or they would need to make it permanent. So why don't we talk about these 4 key new ones, and some of them are very new and never been introduced into law before. So why don't you help us cover some of the new items that we should be on the lookout for?
Sure. The first one is the no tax on tips deduction. Obviously, the government had to put a limitation on who was eligible to do these. It's usually the traditional people that are generating tips as part of their salary, bartenders, wait staff. If you have a concierge service, things like that, CPAs, attorneys, insurance people, wealth management people, we don't get too many tips, so we're not going to be.
I haven't gotten a tip in a long time.
So we're not going to be benefiting any from this.
Maybe a stock tip.
Yeah, but basically, if you're generating tips as part of your income, if you're filing a joint return, you'll have up to $25,000 of tip income that will not be taxed. And both spouses do not have to have tip income in order to take advantage of that. But if both spouses do, they're going to be limited to a total of $25,000 on a joint return. For single individual, it's $12,500 of qualified tips. As I said, the IRS is coming up with a list of occupations and for which this will, for who this will apply. Now, couples also must file a joint return in order to take advantage of this. If they file separately, they don't get any of that.
Okay, good to know.
Okay, and the one problem we're going to have for 2025 is and I think it's because a lot of the software and the programming is already completed for W-2 forms, is the IRS is not changing the 2025 W-2 forms to help designate what is tip income. There are spaces on the W-2s from prior years, it's like Social Security tip income, and I think they'll use that as part of the guideline, but I think it's going to be relying upon the employers to provide the employees with what their tip income is and should be.
So there's going to be a bigger onus on employers that are in the service industries, especially hospitality, where they're going to have to really track that, and the onus is really going to be on them and the person that's receiving the tip income to really report and validate.
Correct. And there's also a phase out on that, and the phase out for married filing a joint return begins at $300,000. So there's quite a bit of wiggle room there in order to be able to take advantage of this deduction.
Sure.
The second item was the overtime premium deduction. While this is not a complete deduction for all overtime pay, it's basically the half time. So if somebody's earning time and a half on overtime,
so it's the 50%.
It's only the half time that gets deducted. And again, that's another one that is going to impact your W-2 form. No provisions for 2025 on the W-2 to be able to allow just an automatic number to be put on there. Again, employers are going to have to subsidize their employees with information about how much their overtime was. And again, phase out $300,000 for married filing a joint return. The third item was the personal car loan interest deduction. Up until many years ago, we were able to deduct interest on car loans.
All right.
That stopped a number of years ago, but in order to generate new car sales and to put those back into the economy and to be able to borrow money on them, you'll be able to deduct up to $10,000 of interest on a new car loan. And again, it has to be a personal use vehicle. It can't be a business vehicle. It can't be a mixed use vehicle. It has to be strictly for personal. It has to be a purchase. Leases will not qualify. There's also some other additional rules that are going along with it. One of them is that the major part of the assembly of the vehicle has to be done in the United States. That's why you're hearing some of these commercials now where they're specifically saying, it's been assembled in the United States in a specific city or a state.
All right. So it's important that as a car buyer, when I go to buy a car, at least talk to the dealership to see if it qualifies for the interest deduction, because they should be able to provide that information about whether it was, and I don't know the percentage yet, but the percentage of the car that was assembled in the United States.
Correct. That's
Okay.
absolutely correct. And those are for loans that originated between 2025 and 2028. So if you've already got a car loan this year, it will impact you on
Yeah, that's
that.
the retroactive piece at the beginning of the year. Okay.
Correct. And the fourth item, which we touched on briefly, is the senior, what they're calling the senior bonus deduction. This is an extra $6,000 deduction on top of the standard deduction that is offered to taxpayers that are 65 and over. It is an additional deduction, and you get it whether you itemize or whether you take a standard deduction. So each taxpayer will be taking advantage of that. The problem is there's a short phase out. The phase out is when your adjusted gross income hits $75,000 on a single return
Right.
and $150,000 on a married filing joint return. So that will impact quite a few people, though.
Yeah. Well, but I think we're also looking at people that are mostly retired, so they're usually, don't have any earned income. How does Social Security impact that? Is it just based off the AGI regardless?
It'll be based on what your taxable portion of your AGI of your Social Security
Okay.
benefits is. It does not lower the Social Security. This deduction it's not an above the line deduction.
Okay.
It's a below the AGI deduction, but before taxable income.
Okay.
So your taxable Social Security will be computed the same way it was in the past.
Okay.
But after you're coming up with your adjusted gross income, then you'll apply the $6,000 deduction against it, and then arrive at adjusted gross income.
Okay. No, that's a big savings. I mean, it's a new form of deduction for seniors that we've never seen before. So
Correct.
again, going back to what we talked about earlier, I think a lot of the deductions that were added, and we'll talk about small businesses and businesses in general later, some of the key elements that will help them. But a lot of these are really going to help, middle market America and below in regards to, basically exempting more income by, increasing and improving the deductions.
That's correct. That's correct.
All right, great. So now we're going to get into another area, and it's an important area because now we're moving from, just looking at getting exemptions and deductions to really helping yourself save for your own retirement. And retirement plan contributions and Roth strategies are a big part of accumulating wealth and setting yourself up for a proper retirement. So we're going to go over some of the key provisions and maybe some planning opportunities that we can talk about. So Nick, why don't you help us kind of go over some of the key changes in regards to the Secure Act and some of the changes with the new legislation?
Sure. The first one is for 401ks, 403bs, and 457bs if you're a government employee. The deferral for 2025 is going to be $23,500, and there is the age 50 catch-up allowable for $7,500. So you'll get that to about $31,000 if you want to do the catch-up for 2025. Okay. There's a special if you're age 60 to 63, and it's pretty specific.
Yeah.
That you can, instead of your catch-up being $7,500, it's going to get bumped to $11,250. So if you're 60 to 63, you'll have that additional $4,000 or about $4,000 additional deduction. Unfortunately, if you're age 64, you don't get it.
Yeah, you have to be, I think, by, during that year, you have to be 60, 61, 62, or finish the year at 63.
Correct.
If you flip to 64 in that year, you're out of luck.
You don't get it. Correct.
Yeah. Well, the key thing I want to remind people, your retirement plan, every company is different. Whether you're with Fidelity or Voya or Principal, these are companies that that may be running your 401k plan at your company. You have to look at how you designate your contribution. Some people put in a specific dollar amount, they put in a percentage of pay, and you need to make sure that you review your election to make sure that if your goal is to take advantage of the full deferral as well as the catch-up, you need to make sure that it's coded or elected properly on your form. Now, some companies allow you to use max, what they call max or maximum, and if you can put that in, that you're really telling your company that you want the maximum amount allowable under the plan to reach the IRS limit. But please review your election. Don't assume that whatever you have last year will get you to the point of the $23,500, which is if you're under age 50. If you're over 50, you have to specify you want the catch-up provision of $7,500, And then we're reminding our clients that fall in that window between 60 and 63 to make sure that the 11,000 is elected. Again, that's based on your ability to save, cash flow. But we don't want you to miss that opportunity. But you need to take a proactive look at what your deferral is and make sure that the proper election's in place, that if you want to maximize it, you can. So why don't we talk about the IRAs, simple plans, and some of the other tweaks and turns here.
Sure. For a traditional and a Roth IRA, the limit for 2025 is $7,000.
Okay.
With a $1,000 catch-up if you're 50 or over. Again, phase-outs, the income phase-outs do apply here. Under a simple IRA for 2025, the plan limit is $16,500 with the $3,500 catch-up, which will get you to $20,000. Under a CEPA IRA, the maximum is 25% of your compensation, which I think is capped at $70,000.
Correct, for this
for
year, yeah.
2025. And there will be annual cost of living increases that will apply that will change that amount. For Roth catch-up for high earners, beginning in 2026, if you earned your prior year earnings were over $145,000, you have to use a Roth. You have to use the Roth
for the catch-up provision.
For the catch-up provision, right. Correct. They're still trying to implement some of the rules right now, so we're not quite finished with all of that yet.
Yeah, typical taxes, they pass the laws and they let everyone else want to figure out how to implement them, right? Well, a key thing to keep in mind for individuals in planning too is your decision to, depending on where you fall in the spectrum here, whether it's a 401k, 403b, IRA, simple IRA, is making a decision between a Roth and Roth contribution or a traditional deductible contribution. So the key thing we talk to clients about, and again, I don't know, unless you have a crystal ball, Nick, I don't have one, is where will the taxes be when you're in retirement? That's the key issue. So if, for example, take someone who's just getting out of college and they're in the lowest tax bracket. Maybe they're in the 10 or 15% bracket after they get their standard deduction because they're not making a lot of money. They really don't benefit from making a traditional either IRA contribution or a 401k contribution because the amount of taxes they're saving is minimal. That individual might be better off looking at a Roth contribution, and then as their income becomes greater and they get into their higher income earning years, it might make more sense at that point to convert to a deductible form of contribution. And so people always ask, what's the number? And again, it's very individualized. Clearly, if you're at the high spectrum of, the high tax bracket at the 36% bracket or 32, it's probably most likely you're going to be better off doing a deductible type of contribution. And here's the reason. For most people, the whole idea when 401ks came out, and the reason why they made it tax deductible, so that means you got to borrow the taxes that the government you had to pay that year, you got to use that money to invest. The theory was when you retire, you're in a lower income tax bracket. So instead of paying tax at, say, the 32% rate, when you retire, you might be at the 24% rate. And that money, that tax difference between the two brackets is monies that you would have saved. In addition, you had to borrow the money from the government interest-free, and you had that money working for you. The whole idea with the Roth is it flips this. And I think the question you have to ask yourself is, in the year that I'm making contributions to my retirement plan, do I feel I'm going to be in a lower or higher tax bracket when I retire? And that should usually indicate whether, if you're going to be in the same or higher tax bracket when you retire, then you're better off using the Roth. If you're going to be in a lower tax bracket, you're better off doing something tax deductible. But again, we don't know. And so sometimes we'll employ what they call a hedge strategy. So for those individuals that are in the, say, 20, 22, 24% tax bracket, that average bracket, we usually say, well, we can split the baby, split the difference and put some in a tax deductible, some in a Roth portion, because we don't know exactly where taxes are going to be. I mean, right now, we're still lower than we were back in the 1980s, but we've come up from the low part when going way back when the Reagan administration was, when he came in and he dramatically cut income taxes. So we don't really know where we're going to be, but I think it's an important planning point, and it's something you have to ask yourself, I would say safely annually based on what you're making.
Well, as I always tell my clients, maximize your plan.
Yep.
Always maximize the contribution. Also, the other thing to be aware of is that in doing a Roth IRA and even picking up that taxable income can have an impact on your IRMA, the income related monthly adjustment for for Medicare purposes.
Right.
Because the higher your income, the more once the government applies that formula against it, you may end up paying more Medicare B and Medicare D premiums.
Correct.
So we have to watch that as well. Backdoor Roths are still available. I know they tried to undo them, but they didn't get the votes. So
I don't think there's a income limit on doing that either.
There is not. There is not. Then some plans also allow still a mega backdoor Roth.
Right.
But I think you have to be in tune with what your summary plan description is on the particular plan that you're involved in.
Yeah, we don't see much of the mega backdoor only because usually the people that can take advantage of it are people that are really making significant money, like your C-suite people. And not to get down a nerd rabbit hole here, but there's testing that has to go on with retirement plans, and usually companies fail the testing when they try to implement what they call a mega backdoor, and that the people that are using it, which tends to be your highest earners or your executive suite, the government looks at it as like, well, they're getting way too much benefit. The common folk in the plan aren't, and they usually they cap that off. Another thing to keep in mind in the backdoor Roth is really important. However, if you have an IRA out there and you do a backdoor conversion, there's what they call a pro rata, right? A pro rata calculation that you need to do, so that not only do you have to pay tax on the conversion portion, but some of your IRA will be counted towards that, and depending on how big your IRA is in relationship to the conversion amount. So that's a key point, and IRMA is a big deal. One of the planning strategies we look with elderly couples or when they're retired is most people aren't going to burn through all their IRA money when they retire, even though they have these, and we'll talk about required minimum distributions in a minute. So one of the planning techniques is when you think about family planning over generations, we look at, well, if the couple is not going to burn through all the money and they're taking it out at a lower tax bracket, okay, that's great. However, if they can't burn through all the money in the IRA, it's usually not a great asset to inherit. So if I'm a son or a daughter, and if my parents lived to a normal life expectancy and they didn't have me late in their life, I'm probably going to be in my 50s or 60s, which is usually my highest earning years. So if I inherit that IRA, I'm required by law to take it out over 10 years. I'm going to pay more tax than what my parents would have. So part of the strategy sometimes is to take a portion of the IRA that my parents would have and have them do Roth conversions so that I can inherit a Roth. Now, if I inherit a Roth, I still have to take it out over 10 years, but I'm not paying tax. Again, this is a moving target, so you need to work with your professional to not only calculate the combined tax impact between two generations, but IRMA is going to be a big part of the discussion, because that's going to be an additional cost to the parents. So I just wanted everyone to keep that in mind when they look at doing these Roth conversions for parents that are or elderly that are retired. It's again better to think about leaving a Roth IRA than a traditional IRA.
Correct. Then there's one other planning note that we use in preparing tax returns for married couples. We always test the married filing separate. Not only to pay less tax, but sometimes even if it requires you to pay more tax filing separately, it may save you in the IRMA calculation, because sometimes that IRMA calculation can be extensive, can be high.
Yeah, great point. And when you're on a fixed income, people, we hear it with some of our clients because they were great savers, and as you pointed out, they start taking these required minimum distributions, and all of a sudden their IRMA goes way up. I mean, the calculation, their IRMA tax goes way up, so they're not really happy about it. I go, well, it's kind of like the government wants a pound of flesh at some point. They let you get away early on, but not later on. So.
And one thing to note as well, the IRMA calculation goes back and looks at your tax return from 2 years back. It's a 2-year look back.
Okay.
And I just had a client call me Saturday who was wondering why his Medicare is going up for next year. And I said, because he almost doubled his income 2 years ago.
Okay.
Of some sales of some things that he had, and we couldn't avoid it. So
Right.
So next year it'll drop again because his 2024 income went down significantly.
So 2025 is really going to look at 2023.
Correct.
Okay.
Correct.
That's great. So why don't we hop into charitable giving? I think there's some really important planning opportunities. There's also been some modifications to gifting. There's I don't want to steal your thunder, but there's a new rule they put in place. But why don't we start there and look at some planning and what people can be doing or be aware of or cognizant of when they're getting into their year-end planning.
Sure. The charitable giving, charitable contributions have always been considered itemized deductions. If you were doing a traditional giving to your church charities, you take it as an itemized deduction. If you didn't itemize, you didn't get any benefit out of the charitable contribution. A couple of things that changed that. One of them is the QCD, the qualified charitable deduction or donation. If you're age 70 and a half, you can give up to $108,000 in 2025. So your money's coming out of your retirement account, but it doesn't show up as your taxable income. Right. And it does take the place of a charitable contribution. You don't get a deduction for it, but you're also not paying tax on the income as well. The only stipulation is that money is not allowed to be given to a donor-advised fund or private foundation. It has to be given to a public charity of some sort.
Yeah, 501c3 as they call it, right?
Correct.
Okay.
Correct. So what's going to happen also I think you're referring to in 2026, the itemized deductions are now going to have a floor on them for charitable giving. Like you've always had the medical deductions at over 7.5% of your adjusted gross income.
Right.
That same theory is going to apply now to charitable contributions beginning next year, 2026. 0.5% of your adjusted gross income is going to have to come off the top.
Okay.
And then your deduction will be whatever is left. And that's if you're itemizing deductions. If you're not itemizing deductions, there's another provision that is going to be allowed.
And this is the brand new one?
This is the brand new one that will allow you to take a above the line deduction for $1,000 for single, $2,000 for married filing joint for a charitable contribution.
Right.
There was something similar to this many years ago, but it was like $200 or $300 a year. This is pretty significant. So, so if you don't itemize because you're under the standard deduction, you'll still be able to take advantage of the maximum of $1,000 if you're single, $2,000 if you're filing a joint tax return.
Yeah, what's some planning strategies that individuals can use to take advantage? Because obviously, I think the last tax bill that was passed, the whole idea was, simplify tax preparation. And when they really increased the standard deduction significantly, a lot of the United States don't itemize anymore. They just can't get over the cap.
Correct.
And so, what's some planning ideas that you can do, especially if you have taxes that you pay, property taxes, which, fall under the SALT limitation, and charitable deductions. What's some planning opportunities for people?
There's one strategy. It's called bunching.
Okay.
Bunching of your deductions. So what you do is you try to plan a 2-year. It's like basically a 2-year deduction plan.
Right.
So I'm going to give more this year because I have opportunities to give more dollars. I have more dollars to give. It's going to get me more bang for my buck to take more deductions. So I'll pile my itemized deductions this year. I'll prepay my real estate taxes. I'll pay more to my state and local taxes. Then my charitable contributions, I may double up or triple up on it. Okay. You'll be able to take advantage of that higher itemized deduction this year. Next year, you can taper off how much you give to charity.
Take the year off.
Take the year off, or give it something less.
Okay.
And fall under the standard deduction, but you'll still get that $31,000 or whatever the number is that you're going to qualify for as a standard deduction, and so you'll get kind of the best of both worlds.
Okay. Yeah, great planning tip. I think making sure people understand that. Another is using a donor advised fund. So while you can't use And I want to go back to one thing you mentioned out earlier. The qualified charitable distribution starts at 70.5, which used to be the old RMD, required minimum distributions. But people, I think I've seen confuse the fact that they can't do that until they think I need to take my required minimum distribution at 73, 74, depending on where their birth date is. So keep in mind the QCD, the qualified charitable distribution, still starts at 70.5 before you have to start taking your RMD. So I think it's an important planning tool. The other is a donor advised fund for people that are very charitably inclined. They can make substantial donations, and again, the QCDs don't count. So this is making a donation of, and we try to steer away from cash. There's another planning opportunity where if you give appreciated stock to a donor advised fund, which Fidelity has one, Schwab has one. We use a company, American Endowment here in Hudson. You can donate that, and the fair market value of that donation counts as a charitable deduction. So you can bunch all that up, and then the other tax benefit is I didn't have to recognize any capital gain in that. The charity will sell that at some point, and then use that money when you decide to make charitable contributions to a 501c3. And that's an important thing to keep in mind with a donor advised fund. You have the contributions you make out of a donor advised fund has to go through a qualified charity, or what the government calls a 501c3. So these are great planning opportunities. Thanks for sharing those. Why don't we go back to the SALT a little bit, make sure people understand, how that bigger cap works, and maybe, and this gets into some advanced planning, but there's some advanced planning that you can do for high net worth to take advantage of that, because the traditional SALT deduction gets phased out after 600,000. So why don't we revisit that a second?
Okay, as we pointed out earlier, up till this year, up till 2025, the maximum you could deduct on a state and local tax was $10,000.
Right.
And that included state taxes, city taxes, real estate taxes, personal property taxes if you had to pay them, sales tax, the whole deal. Now that goes up to, it automatically goes up to $40,000.
Right.
So you can probably take more advantage of your deductions this year, at least as far as the state and local taxes are concerned. And again, if you're short of that $40,000, and you have the opportunity to prepay another 6 months worth of your Social Security, of your real estate taxes, you probably should do it. If you have an opportunity to pay more money on your state and local tax estimates, you can do that as well. So that's one way to cover yourself on that.
Okay, great. Well, that's really helpful. I appreciate the ideas on taking advantage of the SALT deduction and figuring out how to work that better into your planning. So next, I want to talk about 529 plans. I think this is still one of the most powerful financial planning tools because really in the accumulation of wealth, taxes is the biggest drag. I think people worry about markets changing and hurting their values, but the market's very predictable long-term, less predictable short-term. But I think 529 plans, especially with some of the changes that they've made, really offer a window of opportunity for people to consider. So why don't we dive into that part of our discussion today?
Sure. As people are aware, 529 plans are state tax planning plans where you can put money away in a plan for future education, college. Now you can use it for high school, and I believe you can also use it for elementary school
Correct.
as well, as long as it's private schools. Problem is, as we go through time, all of that money may not get used for education purposes.
Yeah, it's hard to guess exactly how much you're going to write a check for.
Right. So what do we do with it? So you can gift that money to a beneficiary, to up to $19,000 per recipient per year.
Right.
So on a joint return, if you split the gifts, husband and wife can each give $19,000 to get that to $38,000. Or you can also do what they call front end load, which is a 5-year plan. So you can give up to 5 years times $19,000, which is if you do that on a joint return, it's $190,000.
Okay.
And you can split that between the husband and the wife. That money then can go to the beneficiaries.
Okay.
And they can use that for whatever they want to use that for, into their 529 or whatever they're going to use it for. The money could also be rolled over into a Roth. and that was, I think that was from the Secure Act from a couple
Right. I
of
think it was
years
Secure Act
back.
2.0, right?
2.0, correct. The problem is you can only donate or give away $35,000 per beneficiary, and that's over the course of multiple years. The the other issue is the plan must have been open. The 529 plan must be at least 15 years old.
Right. That's important.
You can't open up a plan and then
Pull the money out.
roll it over. Yeah, roll it over. So the plan must be at least 15 years old, and the contributions that you're giving away out of that plan have to be at least five. It has to be at least 5 years old.
Okay.
Or over 5 years old.
Okay. Now, I think the key thing too is that if your child, who's probably an adult now, has the 529 plan, if you do a conversion of the 529 plan into their Roth, they can't also make a Roth contribution. So it's an either or.
Right, you're
correct?
maxed out at that, whatever that Roth contribution is for the year. Correct. So again, that's any leftover college money can help seed some Roth contributions for your children.
Yeah. Well, I mean, it's a great option. It gives them a great start on saving for their retirement. Obviously, prior to this, people would just hold on to the Roth, and then because really the grantor who makes the Roth contribution is the owner of the account. It's the child, in this case, is the beneficiary. They don't really own the account. Right. So at some point they would really switch over and allow the beneficiary to become the owner of the account. And technically they could use it for their children or the grandchildren of the parents who originally set up the 529 plan. So it's not lost, but I think part of the thought process here, and we talk to our clients about this, is we do a lot for our kids, but sometimes we forget about, hey, when we hit retirement, our kids are just starting in their career. They're not going to be able to help us a lot.
Right.
So make sure that you pay, my dad always told me, pay yourself first. So that goes into retirement. I got to make sure I'm viable as I go in retirement. So this is a great flexible tool to utilize. We've actually used 529 plans in estate planning. We actually open them up for the parents, and they max fund the plan. And then they always have access to it if they need to bring it back. They have to pay taxes if that ever happens. But the goal is that money that they super fund for their own accounts could be used for future generations' education. So it's a very flexible tool. I think people are utilizing it, but they don't realize how much more they can utilize it.
Well, one other point for those of us, and I'm sure it's pretty much everybody who's watching this podcast, has had to go through the FAFSA forms where you had to fill out those for your children.
Favorite time of year.
529 plans count in your FAFSA as income or as an asset. The Roth plans do not. So if you convert it to the Roth, you're helping yourself, divest yourself of anything that's going to be considered in the FAFSA plan as well.
Great point. Great point. All right, so now we're going to jump into, as we started kind of alluding to that with the 529 plan, gifting and estate basics. We're going to talk about some of the things that were changed in the Act. And one of the ones you'll bring up is really, I think, beneficial for, definitely affluent people. But I don't want to steal your thunder. Why don't we just kind of go through some of the changes in the gift tax exclusion, the estate tax, and maybe some planning.
Sure. The annual gift is now for 2025 is $19,000. Again, as I pointed out before, if you do a split gift between husband and wife, they can each give $19,000 to any beneficiary, so it's a total of $38,000.
So that means they don't have to file any type of gift tax return.
Correct. Right. Yeah, no gift tax return is required. The lifetime estate exclusion is now just slightly under $14 million.
Okay.
It's $13,990,000. For next year, for 2026, that jumps to $15 million.
So they're going to index that with some form of an inflation factor?
Correct.
Okay.
Correct. Then there's also this no clawback rule.
Okay.
The no clawback rule is so it eliminates the potential penalty for paying tax on a large gift which was made between 2018 and 2025.
Okay.
And then if a person dies in 2026 or later, they will not have to go back and pay the tax on that difference.
Okay, great.
Okay. So that's what they call the no clawback rule.
Yeah, the one thing I do want to add, I mean, a lot of people think of gifts, they think of cash gifts. We do recommend people, if they give interests in, family-owned businesses, because with that you need to have some kind of valuation. By filing a gift tax return, you actually start the clock, I believe, and it's a 7-year look back, basically. So, if you don't want your tax return to, because without filing a tax return, the IRS can look back indefinitely. So I think when you gift assets that are not cash or market valued like stocks, anything that's a private asset or privately owned interests in businesses, filing a gift tax return, even though if you don't have to, at least starts the clock running for the government to review the tax return. So another thing, I think a key point, and it's a little bit of a planning. Everyone thinks about waiting till they die to take advantage of the estate and gift exclusion. And remember, your assets are going to continue to grow, and even though the estate and gift tax exclusion is pegged to inflation, if your assets are outgrowing that, it could eventually, if you're in a very affluent individual, it could, your assets could overcome the value of the estate and gift tax exclusion in the future. So sometimes making gifts of appreciated assets today to family members, children, removes that asset out of your estate and the growth of that asset. So there should always be some discussion with your estate planning attorney, your CPA firm, about, does it make sense to make some gifts today and utilize some of the estate gift tax exclusion, because it is one combined credit, right?
Correct.
Okay, great. So the next area I want to touch on and ask Nick his guidance, because this gets a little bit confusing because it talks about the different types of business entities out there. But for those that have family businesses and have children, in certain situations, doing income splitting or paying children wages can really help lower all, the effective family tax bracket. I guess the best way to say it.
Okay.
So can you give us some guidance on how individuals who either want to do income splitting, or even better, income splitting in a sense of paying their children for viable work. Okay, there has to be some viable work here. How that kind of works and how they save and what pitfalls to think about or worry about.
Yeah, what we've seen with in businesses, if you have a sole proprietorship, you're filing a Schedule C, or you have a partnership where both partners or both parents are partners, or partners are parents, and there's nobody else involved in the business except for those two as the owners. If you hire your children, again, it has to be a viable job. You can't make your 2-year-old the executive vice president, pay him $1 million a year. That can't work. It has to be viable work, and it has to be a fair amount.
Cleaning floors, emptying the trash.
Correct.
I mean,
Correct.
Right.
So if it's a Schedule C, sole proprietorship, or partnership where both partners are the child's parents, on the wages that you pay your children, if they're under 18, there's no FICA tax, no Social Security tax to be paid by the child.
Okay.
If the child is under age 21, there is no federal unemployment tax to pay on behalf of that child. You still have to withhold federal, state, and if it's under 18, at least in Ohio, the cities, there's no city income tax as well.
Okay.
So you'll pay federal and state. You have to issue a W-2, and you should keep some kind of contemporaneous timesheets,
Right.
time records of what the child did when they worked.
So I can't just say, take my word for it?
No. Well, you could say that, but it's not going to work.
Yeah.
If the business is an S corp or a C corp, or a partnership with any non-parent partners, the children are subject to the FICA tax and to the federal unemployment tax, just like a regular employee would be.
All right.
So that's the catch, is to make sure that the parents are the only owners of the business.
Okay, great.
Okay. Talking about the kitty tax, or the cat, what people would do back in the day was, parents would take their investments and they would put it in their children's names.
Right.
And under the laws, the way they were many years ago, the child would pay tax at their rate only on all of that income. Well, in order to make it fair, the parents now there's a kitty tax on the children, basically usually paid by the parents. but it's any income, any earned income, or any income, I should say, any unearned income, interest, dividends, and capital gains, that are over $2,700. The first $1,350, the child pays no tax on it.
Right.
The next $1,350, the child pays whatever the child's tax rate is, and anything above that $2,700 will be taxed at the parent's marginal rate, whatever the next dollar of income, whatever
Right.
rate the parent would pay, that's what he's going to pay on that difference.
Okay.
Okay.
Wow.
The children are given a standard deduction of $1,350 plus $450, or their amount of earned income, whichever is greater. So that's why another thing you can do if you want to jump into this is you can open up a retirement plan
Right.
for the child, as long as they've got earned income and up to that $7,000 maximum amount. Even if the child doesn't have the cash, the parent can always gift them the cash in order to be able to fund that.
Right.
Okay.
As long as they have earned income, they can contribute to like a
Correct.
Roth up to that earned income amount.
Correct.
Okay, great planning tool. So great, thanks. Hopefully that's an important segment. It's a little convoluted in the sense that, again, you have to look at the entity. S corps, C corps don't qualify. So make sure you talk with your CPA in regards to, is this a viable planning opportunity to shift income to the children, take advantage of their standard deduction, and lower the overall, I guess. We always look at families as a family tax. So, while kids are under 18, so if your overall tax as a family comes down, it usually makes sense. So the next area we're going to do to round out our talk today is, there have been some really significant changes in deductions and in expensing of assets for business owners. And I think it's really critical to touch on this because, a lot of business owners are in S corporations and partnerships, even C corporations, but your smaller businesses tend to fall into what they call pass-through entities. And these deductions are really significant in regards to helping them invest in their businesses and getting a chance to get a write-off. So why don't you lead us through the home stretch here?
Yeah, one of the major things that occur with the one big beautiful tax bill was the permanent law into effect of the 100% bonus depreciation.
Okay.
Bonus depreciation had been around for a while, but they changed the amount, they changed the longevity of it. It's phased out. It's this, it's that. Beginning with this year for 2025. The bonus depreciation will allow you to 100% expense business equipment, property, that type of thing, as long as it has a life of less than 20 years, and it was acquired and placed in service after January 19th of 2025. And that date is pretty specific because it's the date, the 2 days before the inauguration.
Okay.
So
didn't realize that.
Now, one of the things that you can do is if you're, for example, let's say you're building a building or you built a building, and you have to put machinery and equipment in. If it's some kind of if it's a manufacturing company, if you do what they call a cost segregation, you take basically what the cost seg does. It takes that building and breaks it down into components.
Okay.
So instead of just having a big building, you now have a building with different pieces and parts in it. What's significant is if you have to buy a piece of equipment and that equipment has to sit on a platform, like a permanent platform that's in the floor, it has its own foundation and everything else. If you just include that as part of the big building, you're going to have to write that off over the life of the building.
Right.
Not eligible for the 100% bonus depreciation. But because it's for that specific piece of equipment, if that equipment wasn't there, that foundation wouldn't be there either.
Right.
You can count that as part of the
machinery.
The machinery.
Oh wow, that's
so
great.
you'll get an accelerated write-off of 100% of that foundation and the equipment.
So when someone's going in and doing construction and all that, it's important to have the CPA and the contractors all figuring out, okay, what's actual building and what are the components that really don't follow, aren't part of the building and really are part of the machinery and equipment.
Correct.
Okay.
Correct.
Great.
Another thing that has been restored for years beginning after 2024 is the R&D, research and development expensing.
Okay.
Previously, it had to be amortized over a 60-month period.
5 years, all right.
5 years, but now it can be expensed as it's incurred. But it has to be domestic treatment. It has to be domestic R&D. If it's foreign R&D, it has to go back to the 60-month
Okay.
amortization.
So the R&D has to basically be done on U.S. soil.
Correct. There's also the 179, Section 179, which is another 100% write-off of equipment, but it has a different wrinkle to it. If you elect Section 179 for equipment that you're buying, there's a cap on that as far as there's a phase out, I should say, on that. The other problem you have with 179 is 179 cannot be used to create a loss on a business. Bonus depreciation, the 100% bonus, can be used. So what the idea is you use 179 to get that business down to a zero profit,
and then do the bonus.
And then do the
Wow.
bonus to take it into whatever kind of a loss situation.
Now, how far forward can companies carry their losses then?
Well, it depends. I think right now it's 20 years.
Okay, great.
Is the carryover amount. Interest deductibility. There's still caps on interest on deductions for interest, but the OBBB created more favorable business interest deductibility for years beginning after 2024. So starting in 2025 and going forward. The net operating loss rules, there have been some changes to those, not that many though, but you have to kind of look at it year by year as far as net operating losses are concerned. There's been a change made to the QBI, the qualified business income.
Now give some history on the QBI, why that was even created in the first place.
QBI was created because there were pass-through entities that the owners were not being able to take advantage of some of they were paying tax on profits.
Right.
Okay. So if you had a pass-through entity, an S corporation, an LLC, or a partnership, you now got a chance to deduct or take a deduction of some of that profit on the individual's the shareholders' tax return.
Okay. Now, was that brought about? I think because when they lowered the corporate tax brackets, that didn't really help the majority of, and really in the United States, the majority of your small businesses tend to be profit partnerships and S corporations. So was this a way to kind of try to level the playing
right,
field?
Because what they did is they took the C corporation tax bracket down to 21%.
Okay.
As opposed to having graduated rates, it was 21%. So now what does everybody do? Run and change over their companies to C corporation. So in order to make that palatable, one of the balancing acts they did was institute the QBI.
Okay.
Okay. Now for 2026, there will be a little change to QBI. There will be a minimum of $400 QBI deduction now.
Okay.
And there's also now a minimum of QBI income of $1,000. So if you have $1,000 QBI, before you were allowed to take only 20% of that.
Okay.
But now they've increased that to $400, a minimum of $400. So basically, it's 40%. If you only have $1,000 of QBI, you're going to get a 40% write-off.
Okay.
Okay. So everybody will get at least $400 because we've seen in some cases where they're getting literally tens of dollars. They're basically getting not much at all. So this kind of makes it a little bit more palatable. It puts more dollars into the shareholders' pockets on small businesses.
Okay.
Lease versus buy, 100% expensing often wins because if you lease a piece of equipment, you don't get that 100% write-off. You get the lease based on however long that lease is for. That's what you'll get. It's like renting an apartment or renting an office building.
So your write-off is over time on a lease versus you buy a car, you can expense it.
Correct.
Okay. So thank you again, Nick, for joining us here today. It was great. Hopefully the listeners picked up on a lot of good key items that they should consider for themselves if they self-prepare, But again, I think you need to contact your tax professional or your financial advisor for guidance to make sure that the tax planning fits. And one of the things we always talk about is never let the tax tail wag the financial dog. Everyone chases tax deductions, but make sure it makes financial sense for you as well. So you got to balance that. It's like a little bit like a teeter-totter. So before December 31st, meet with your tax advisor to review your year-end strategy and discuss which steps may be relevant for your circumstances. Take the time now to help yourself approach the new year by being prepared and organized. If you'd like additional guidance, we can invite you to give us a call at 440-740-0130, or please visit returnonlifewealth.com to schedule a consultation. And please follow Frank Wealth Insights for more episodes covering practical strategies, insights, and planning considerations for your wealth and management needs. Nick, thank you again so much for joining me today and sharing your insights. I really appreciate your time and expertise in these matters, and I know our listeners will value that too. So that's a wrap, and until next time, here's to health, happiness, and a life well lived.